Jordan, I want to know the why right now. The partial differential, is the euro weaker, or is this just dollar flight is witnessed by strong Swiss franc as well?
Well, I think what Jane Foley was saying before we came on, it has been really surprising how, euro's through parity, but it has been mostly a dollar story. Euro hasn't underperformed as much as I think it should. I think the FX market is totally mispricing the situation in Europe. I think credit markets are doing a better job at pricing in the risk. We're seeing credit spreads widen. But in European equities, they essentially say it's going to be a mild slowdown towards average growth in Europe, where every single day we're seeing violet hills in terms of the energy price spike. It's getting worse. The situation for European energy markets, if you look at the past 22 days, 22nd of August today, check the date when I say that, 80% higher energy prices this month alone, 80%. And we've been talking about this for months. They were awful before we got to August. They're now 80% higher. So if governments do nothing, the UK household, if they have no subsidies, and we know they will have, but imagine the world where they don't, they'd be spending 20% of their disposable income on energy bills for just turning the lights on and the heating in their homes. So the situation is a complete rethink of the economic model in the Eurozone. And it's strange for all of us to see the euro selling off so slowly. I think it should be much faster. We'll be testing 97.50 down towards 95 cents in the next few months.
So you think maybe get down to 95? I guess I would ask off the back of that, Jordan, does interest rate policy even matter in this world to this currency, given we're expecting 50 basis points again on September 8th?
Yeah, there is one central bank that matters, which is the Fed. If you look at FX, what's been quite strange is idiosyncratic stories in Europe and all the detail we can go into have been largely irrelevant for the past few weeks at least. All you needed to know was what's going to happen in US rates, and you knew where euro-dollar, where cable was going to go. I think in the winter, it'll be so obvious to everyone there is an extreme recession taking place in Europe that those idiosyncratic factors, this energy story, what's going on for the European consumer will matter. The other factor to take into account is that it's not just about what the ECB does and what the Fed does. You have to take into account the market's inflation premium. So a lot of questions this morning from clients and investors. Why is the euro lower when spreads would actually say, nominal yield spreads would say euro-dollar should be higher? Well, it's because there's now a large inflation component in yields of EGBs and UK gilts. You have to treat it a bit more like an emerging market. Their rates markets are selling off and their currencies are heading lower. That is very different to what we've been used to for the past 20 years.
Jordan, the fact that you think that the euro is wildly mispriced, or the market has underplayed some of the weakness, is in stark divide with what we heard from Ian Shepherdson earlier on the show. He said if you're not expecting recession in Europe, you haven't been paying attention. What is the distinguishing feature of why you think there has not been the recognition that you're talking about in the currency markets to date?
Well, I think the market's just been looking at the Fed. And we had that CPI number and the market pricing a Fed dovish pivot, which kind of has come out the price a little bit. We've seen the rate cuts for next year. At one stage, there was 75 basis points priced in. That's now eased off quite a bit more. It's below 50 basis points, I think, this morning. But essentially, the markets are feeling pretty yellow about the Eurozone, but it's only credit that seems to be reflecting it. And eventually, it will feed through to the other markets. It happens all the time. Markets are not perfect. They're not always rational. And they just sometimes need to be given the alarm bells, such as the ECB, for example. Do we really think they're going to keep raising rates next year if there's blackouts in Germany? So that could be one of those trigger moments when the lights are literally turned off for German industry or parts of it, where it just becomes unreasonable for euro to keep the levels it's currently at.
Jordan, this raises an important question, and I'm not comparing the two situations. I just look for a catalyst. Back in the pandemic, we all saw this risk brewing, and the market was unshaken, unmoved. And I think it was that weekend when Italy shut down that people woke up on Monday morning and thought, wow, this is real. It's coming, and it's probably going to come to the United States as well. Jordan, with that in mind, are you thinking of that kind of catalyst? Because, like you say, all of this is so obvious. We're seeing it play out. You can see it on the screen. You see it in the numbers, in the price of gas, and yet very calmly, very slowly, just sort of breaking down again. What's the catalyst you think that's going to lead to the wake-up call?
I think you're right there, John. I think the human mind is a part of the reason why it's difficult for markets to price this in. We are linear animals. We think in linear terms. Where these energy prices are rising exponentially, it's just really difficult for us to comprehend the impact of it. There's another aspect to it as well. We do expect that governments will step in. If they don't, they'll be risking civil strife, essentially. So there is an aspect of the market which says, don't worry, it is pretty bad in energy, but they're going to do something about it on the government side. The point I'm making is when energy prices keep rising, it's 80% in the past 22 days. It's really difficult for governments to keep up with those sort of moves. And supply is the problem and price is the problem. So there's two aspects of that. The trigger could be, John, essentially when Germany triggers phase 3 of its gas ration plan. At the moment, it's slowly going to give up the cost to consumer. We've had some mixed moves from Germany. So we've got an energy levy coming in October, but they're also cutting VAT. So it's kind of offsetting it to some extent. When phase 3 comes in, the government actually just needs to do demand destruction policies, literally saying you can't turn on your industrial plant. You need to turn down your gas usage. When that happens, it becomes much clearer to everyone that the Eurozone will use a lot more imports to help their supply chains continue. Factories will still want to keep producing, keep their jobs. But for certain products like steel, aluminium, glass, ceramics, plastics, chemicals, anything that's at the lower end of the supply chain but very highly energy intensive, will just get imported from America, from China, where energy is much cheaper.
Yeah.
And that's going to weigh on the euro even more.